Hello friends, welcome to yet another video in our series Finance and Investing Tidbits. In this video, I'm going to talk about and show you 5 important charts. As an investor, you must always track these 5 charts. As I have mentioned in one of my earlier videos, a lot of time gets wasted on administrative stuff. TDS, ensuring that we collect the necessary forms and all those kinds of administrative work takes a lot of our time. But we don't have time to focus on the most essential part of investing, which is to understand how asset classes are moving. And through these 5 charts, which I have downloaded from tradingeconomics.com, and I would encourage all of you to have a look at that website. It's a portal with data for practically every country on a number of parameters. And I have downloaded 25-year charts on 5 important aspects, which is what I'm going to show you and even explain to the best of my ability how you can read those charts and align your investments. So welcome to this video. The first chart which I'm going to show you is that of MIBOR, Mumbai Interbank Offered Rate. You must have heard about LIBOR, which is a very old construct. MIBOR is also something which is on parallel lines, which indicates the short-term interest rates which are prevailing in the interbank market, right? So what we see here, as I've already mentioned, is a long chart, 25-year chart. When we look at any chart, we must always look at 2 dimensions of that chart. One is a structural, which is a long-term dimension, and second is a cyclical dimension of the chart. Now, as you can see, though the structural dimension is not very profound here, but generally you would agree with me that the direction of interest rates has been on the lower side. Perhaps if we had looked at a chart beyond the 25-year period, we would have probably noticed it in a very evident way. Here it's not so obvious as it may be obvious in some of the later charts. But what we can say is that the long-term direction of interest rates is that of gradually coming down. But within that, we clearly see a cyclical pattern. In 2004, the interest rates had come down and then they rose consistently. Again, there was a sharp fall during the Lehman Brothers crisis. Then they again started rising as the economy recovered from that shock. And after a while, after the 2013 challenges that we faced in the Indian economy, and then there was a political transition, after that they have again started falling. They rose a little bit, but again have been falling. Then they kept on falling steeply during this COVID period, where they went below 4%, 3.75 kind of a rate, and then it has again been recovering. Now, why this chart is very important for us? In one of the earlier videos, in fact just the previous video that I have released, I have talked about how through 2 schemes we can create a portfolio, and that can be very effective portfolio from a return perspective. And I had mentioned there that one of the schemes out of those 2 is a money market fund. Of course, there are some other variants like liquid fund, overnight funds, depending on the short or very short or ultra short duration of their investments. But the point that I'm making is that these funds have been generating very low returns during this COVID period, and we can see the obvious reason for that. Now, sometimes what happens is if a particular scheme is not performing, people go to the advisor, and then the advisor says that, okay, let's move your money to another scheme. Now, if your money is moved to another money market scheme, right, it's not going to create any dramatic shift in your return profile, because the return of both those schemes, the one that you switched out of and the one that you are switching in, are all dependent on the same thing, which is the MIBOR or Mumbai Interbank Offered Rate, unless the advisor is asking you to shift to a completely different asset class. But quite often I have seen that advisors advise people to get out of one bond fund and put money into another bond fund. Now that's not going to change substantially the way the returns are going to unfold, right? So we should save ourselves from those misfortunes, because when you switch out of one scheme, there could be a taxation implication for that. Plus there is a transaction cost when you move to another scheme. And as a process, your own return, gets diluted. So once we know that this is a period like what happened during the COVID period, which is not going to generate superior returns on a money market fund, we just keep quiet and wait for things to change. And as I have kind of mentioned in some of the financial wellness talks that I gave in Utkarsh Mandal Vile Parle, and you can see that entire playlist of 4 videos, and in the 4th video there is a downloadable note. So that was prepared in November, December of 2021. You will find references to what I'm talking about today, 6-7 months later, where I had mentioned that as the economy is coming out of the COVID pandemic, the interest rates will start going up. And the same money market funds which are not giving you good returns will start giving you good returns. So this is a great time where money market funds can generate returns, because as we can clearly see, the short-term interest rates are rising, and money market funds exactly invest in those instruments. So their return profile will improve as compared to what happened in last 2 years, or for that matter, what happened since beginning of 2020 itself, when they started falling, right? So you must have a look at this chart to be aware what is going to be your return profile on your money market funds. Thankfully, next couple of years would be very good for money market funds, because there is going to be more credit offtake. People are going to demand more credit from banking system. The deposits growth may not keep pace with it. Banks will have to raise their interest rates on even deposits. But the good advantage of some of the mutual funds that I have already spoken about in my previous video of those 2 schemes is a certain clear tax advantage once you are able to build a pipeline which goes beyond 3 years. I'm not going to elaborate on that, but if you download the note, and in case somebody is not able to get it, you can put a comment under this video, and I can make sure that I will make that note available to you. It's an 80-page note which will give you a very good backgrounder on building your own investment portfolio, right? So long and short, when you are investing in money market funds now, you will get better returns than what has happened in the past. But you must remember that this cycle will also last for a few years, and again there will be a decline there. But doesn't matter. This is something that we got to observe, from the charts, and then ensure that we align our investments in appropriate assets. Let's go to a few other charts. Here is another very important chart. Advisors tell us about investing in gilt funds. Gilt funds are those which invest in securities issued by the central and state governments. Of course, now there is a window available for retail investors to even directly buy those bonds through the RBI created window, right? We must remember that even if we are investing in a government bond prices have an inverse relationship with interest rates. So if you see my talk during November, December 2021, I had forewarned investors not to put fresh money into gilt funds or bond funds. I'll explain the reason why. Now here again, let's have a look at the structural direction. We can clearly see that the structural direction is that of a fall here. The yield, which is the market expectation on these government bonds, was as high as 12% in the 90s, and then it has fallen to now about 7.5%, right? It had fallen to 5.75% during the COVID period. Now, when I mentioned about inverse relationship, when the market expectation from government bonds to fell to as low as 5.75%, as you can see in early 2020 during the COVID onset. from a level of 8% sometime in 2019, the bond funds or government oriented, government securities oriented gilt funds generated excellent returns, because at that time the expectation of the market was consistently falling from 8%, as you can see in this chart, to 5.75% during the COVID period. So when interest rate expectation in the market falls from these government bonds, the bond prices rise. Now why so? I have again videos on my channel. You can explore those, and if you're not able to get them, again put a comment. I'll ensure that the link is made available to you, where there is that inverse relationship. So here the bond funds and gilt funds did exceedingly well between 2000, say 18-19 to 2020, early 2020, or even some to that extent late 2020. But thereafter, as the interest rate expectation has started rising, particularly recently on account of the global inflation, tightening of interest rates, in the context of India, fear about oil prices, all that has resulted in some kind of a surge in the expectation of the market to 7.5%, and it is stabilizing there. So we'll have to wait and watch, but the way I'm looking at it is that till the time oil starts cooling down in the market, global market, the yield expectation may not start to come down. But when the oil prices correct, and that can happen quite dramatically, as much as dramatically they have gone up on the back of Russia-Ukraine war, if things cool down there, the oil prices can also very quickly collapse. If that happens, and gradually, as we are already experiencing, the global commodity prices have also started correcting. And if the overall inflation expectation starts coming down, we will also see some kind of a fall in the government, the yield expectation from government bonds, and then the mutual funds which invest in those government bonds and corporate bonds will tend to stabilize, and the fall in their NAV will get arrested. Otherwise, you will see in last 6 months, if you analyze it, the NAVs have either fallen or in some cases remained completely flat, giving no return at all. But in most cases, they have given negative returns for this simple reason. So now the question is, should we invest in government bonds or mutual funds investing in such government bonds? The answer is yes. Because if you are able to lock in a 7.5% return, and if you are prepared that you may not get handsome returns over the next 6 to 8 months, or you may even get marginally negative returns in case something worse happens, but otherwise, you are able to, or you are going to be able to get a much better return than what you can generate today on bank deposits. Plus, if over a period of time the interest rate expectation again starts falling, which it would, because as you can see, cyclically there are ups and downs. So while there could be an up move, then again there will be a fall which will happen. And as India is becoming a more developed economy, it is very natural that inflation over a period of time will also tend to get lower, and so would the interest rates also tend to go down. Now that is very supportive of bond prices because of the inverse relationship that I've already mentioned. So while I told people not to invest in government bonds in late 2021, today it's a very attractive yield, 7.5%, and therefore you may consider buying some of these bond funds which are specifically oriented towards the government bonds in a staggered way. We never should rush into buying. We should always stagger it, because market can always surprise us on the negative side or on the positive side, both ways. So it is quite possible that 7.5% may further go up to 7.75 or 8 if some negative geopolitical event happens. But otherwise, there will be a quick cooling down also, as you would have seen that earlier in 2014 it had peaked to 9, then in 2018-19 peaked to about 8, and even earlier to a little over 9, but then it corrected. So when that correction happens, your investment in gilt or bond funds will generate again superior returns for you, right? So this is how we need to get familiar with this chart. Let's come to this third chart, which is our favorite Sensex. As all of us know, Sensex is the top 30 stocks in the country. Now, one thing remarkable in terms of the long-term direction of this stock, of this chart, the structural direction, which is very heartening, is that it is structurally on the rise. In other words, that as the economy progresses, now here again I have mentioned about the relationship between the economic growth and Sensex. Just to quickly give you a flavor, over a period of 19 years from 2002 to 2003, Indian economy real growth plus inflation together has grown at a little over 12% up to 2021-22. And during the same period, if you look at the Nifty or Sensex as on 31st of March 2003 and say 2022, it has generated a return of 16%. So 14 to 16%, 14 on a conservative side, 16 on a realistic side, somewhere in that range, the market has given the return plus another 1.5% to 2% on account of dividend yield. So what we can clearly see is that the long-term trend of Sensex is rising, and therefore we must take advantage of aligning our investments to equities as much as possible. As I have given the disclosure time and again in various other videos, 97% of my financial savings are in equity, right? That includes, financial savings include even gold related investments. So technically gold is a physical asset. But what I'm saying is whatever is my discretionary saving, apart from the flat that I reside in, 97% of that is in equities. For the simple reason that equities provide us the best possibility of a return, right? And therefore we must align our kite with the wind, and the wind is, in spite of the ups and downs in the market keeps on taking all those challenges in the stride and keeps on growing. So we have seen a fall on the back of, or an accelerated fall on the back of the Russia and Ukraine challenge. But then we are seeing now that the market is stabilizing. Please explore my video about how to assess market level. There is a downloadable Excel file so that you yourself can keep track of where the market is currently in the context of the historical events and the economic growth. So in my view, market is at a very, very attractive juncture for long-term investments. And you may or may not agree with my analysis, but do at least explore that video where I have shown how to measure Nifty in the context of historical Nifty levels and the economic growth. So the point is that Sensex, as clearly we can see, the stock market keeps on moving forward. It keeps on absorbing a lot of challenges. And as we can clearly see, I have again created a video right in the thick of the COVID pandemic, where, as you can see here, Sensex had a major fall in just 1 month, right? Even during that time, I had created a video in terms of how attractive equity investments are, in spite of the fact that there was a 50% drop in my own personal portfolio just in 1 month. So if we are able to hold our cool and align our cash with every equity opportunity thrown at us, we are able to build a very strong capital base. We are able to compound very well. So this is a chart we should always look at from a long-term perspective, and the steps that our country is taking, which are very good from a long-term perspective, the Atmanirbhar Bharat, the emphasis on domestic manufacturing and exports, the PLI scheme, the fiscal discipline, buoyancy in the tax collection, our steps that are being taken for controlling inflation, the way RBI and the central government is working in tandem to ensure that growth happens in a difficult environment. All these bodes extremely well for our economic growth potential, and naturally we must align our investments as much as possible to equities, while keeping in mind that we should never run after returns. we should always focus on the risk management, and do explore my video on that theme as well. I'll again give a link to that video in the description box. So the point is that if we are able to defensively manage our investments, do explore my holding company investments related videos. Those are all tools which are used for a defensive way of investing our hard-earned money. And obviously, when I'm going to turn 60 later this year, and when I have significant family responsibilities, I cannot take undue risks. But the point I'm making is, if you are able to manage your risks in equity investing well, by ensuring that you have a focused portfolio rather than going for any share that any analyst keeps on recommending or writing about, please don't do that. Don't fall into that trap. While I respect those analysts, and they're great presenters, and they have successful YouTube channels, but that's not the way investing is done, because a stock, a share which is widely known, will never give you superior returns. So instead of running after such videos and such recommendations and articles, you might as well invest in an index fund, as I have mentioned in one of the earlier videos. If you are great in stock picking and you're able to make focused investment in those stocks where you are convinced about your own research and why you're investing there. Like I have already mentioned, I have only 5 shares, right? And I have significant investments out of my savings into them. And I seriously track them, and I'm very happy. I don't even look at a 6th share. So if you're able to do that, then you can focus on equity investing. Otherwise, don't create a portfolio of 30, 40, 50 stocks based on every recommendation given by every analyst. Remember, no analyst is going to tell you when to exit, right? Entry is always easy. So don't succumb to that particular trap. The next one, which is important for us as a country, is crude oil. As we have seen during the COVID pandemic, oil had fallen to the 20s, very close to $20 a barrel. And from there, it has surged clearly 5.5, 6 times, right? Now it seems to be stabilizing and correcting a little bit. And as I mentioned, if there is a solution to Russia-Ukraine war, or at least if the Russian oil gets available in the market, and the politics behind keeping oil prices high, gives away to more rational thinking, we would actually see quite a quick correction in the oil prices. But how long it will take is anybody's guess. But when that transpires, that will happen very quickly, because as I've mentioned in some of my other videos, particularly the video that I created on 9th of March this year after the Ukraine-Russia war broke out, I had mentioned in that video that even the oil producing countries cannot afford to keep oil prices at a very high level, for the simple reason that high oil prices would spur innovation in other energy or other ways of driving automobiles. And then once that happens, while these oil producing countries will have a great run when the oil prices are high, they are going to invite doom to themselves, because it will spur innovation, it will create a transition to other fuels, like what we are already trying to do in our country, where blending of ethanol is now going to happen from 10% level to 20% level. We are already talking about green hydrogen. We are already implementing CNG, electric vehicles. So all that will cause a challenge for these oil producing countries down the line as those shifts get accelerated. So they themselves can't afford to keep oil prices unreasonably high, and I'm sure there will be some kind of a semblance of rational thinking there. What we can see is that oil prices rose up to 2008. I remember in July 2008, exactly 14 years ago, oil prices had reached $147 to a barrel in intraday trade. Though of course it doesn't get reflected here because this is based on weekend prices, right? So it's not capturing the during the week move, which was sharp, and then there was a correction. But you can see even on the weekly price chart, there was a solid correction between July and October 2008 from $147 to a barrel to just $35 to a barrel. Again, that $35 is not visible here, That was again during the week. The weekend price shows to be around $45 here. But the point I'm making is that in the long term, the oil prices, in my view, are going to be on the decline in spite of the fact that oil is in short supply because of the transition to other technologies. No oil producing country can afford to keep oil prices very high. So I'm sure this rationality will ensure there is a correction, but it may take a little longer depending on how the Russia-Ukraine war remains on the horizon. If it remains on the horizon for a longer period, there are other flare-ups, other geopolitical flare-ups, then this could remain sticky at a slightly higher level for a little longer time. But from our perspective, as I had also predicted in my March 9, 2022 video, I had predicted there that Indian government, being what it is and very shrewd, I won't be surprised. I had said that they are able to negotiate with Russia, a much better price. And within 15 days of that video, there was this news that India has signed up a deal with Russia in spite of the pressure from the West and the NATO countries. India has started accessing Russian oil. And now through the Chabahar port, if that access opens up and through railways as well as the road network, then imports from Europe or exports to Europe will also become quicker for us, and we will be able to save on the transportation costs. So clearly, it's an area of concern for our country for now, but I'm sure, through shrewd diplomacy, we will be able to tide over this situation, and over a period we will actually see a decline in oil prices, particularly if the possibility of American recession happens. It will be a boon for us because American recession will ensure that crude oil prices soften. If they indeed soften, then that's going to be a boon for us. So this is a chart we need to keep an eye on because a lot of our growth depends on it. Lastly, let's have a look at one other chart of a commodity or a precious metal that every Indian is fond of, and that's gold. So what we can see in this gold chart, now remember these are not Indian domestic prices. Indian domestic prices of gold depend on a few things. One is the international price, second is the import duties, third is the dollar rupee parity. Now we all know that rupee has fallen. There is also talk about some additional taxes on gold, right? That's what I've heard. I may be wrong, but all that has created some expectation of a higher price in the domestic market. But see what has happened in the global market. In the global market, on the back of Russia-Ukraine war, there was a flare-up in the gold prices. But we clearly see that gold prices have softened to a little more than $1,800 to an ounce. But in the long term, as again talking about the long-term chart, gold is in a long-term bull market. In other words, if you are willing to be patient, and sometimes the patient can be over a decade, it may try your patience over a decade, like what has happened between 2012 and say 2015 or so. The gold prices actually declined, and quite often mutual funds have this knack of coming out with schemes when they are able to show fantastic returns on something. So a lot of gold related mutual funds were launched in India in 2012 when they could show stellar returns on gold, and after that all those gold investors suffered. But from an absolute return perspective, they would not have suffered if they have been patient, because at that time the Indian price of gold was 32,000, though globally the price, the peak of 2012 and 2022, gold prices have not given any return, because in both these periods they were around $1,800 to an ounce. In India, gold has given returns because of the fall of the rupee against gold, against the dollar. because of domestic inflation and other factors. So over a period of 2012 to 2022, gold in India has given returns, but globally we can see that with all those ups and downs, gold has not given substantial returns. But in a situation, if debt crisis unfolds in some of the developed countries, like I have mentioned in some of my videos, that some of the countries which do not have demographic dividend, their population is not growing, the growth of the economy is anemic, but yet they have, amassed a lot of debt, right? They have financed their expenditure out of borrowings. Now there could be some problems which may come out of those skeletons in the years ahead. Now that can again cause a flare up in gold prices. So over a period of time, we find that gold does give good returns, say about 9 to 10% in the Indian context. Though in global context, gold gives returns in a quick surge, and then it may not give returns for a long period of time. Even in India, that happened. From a peak of 32,000 of gold prices in 2012, they fell to about 23, 24,000 a few years later. And again, from there, they have risen. So what we have to be mindful is that, yes, in the long term, gold always gives us positive returns, but we cannot take it for granted. There is a cyclicality there also, though as it appears, the cycles are of a much longer duration. Gold becomes a favored investment whenever there is a crisis in the world or in specific countries where people move to gold because they always feel there is value protection in gold. But personally, while I have some investment in gold, uh, it's still a much smaller fraction as compared to my investment in equities, because equities generate far superior returns than what gold can do. But since gold is also something which is liked by Indians, I thought of presenting that chart also to you. So friends, before I conclude, I would like to mention that keep an eye on the charts, explore trading economics. You can decide the time frame on which you would like to view the chart: 25 years, all time, 5 years, 1 year, 6 months. But do make it a habit to have a look at the charts so that you clearly know what is the direction in which you are able to generate returns on different asset classes. And as an investor, it is our responsibility as well as an opportunity that we put our money into those asset classes where there is the highest potential to generate returns, right? So I hope you got a good flavor of that by looking at the charts. Of course, I'm subject to correction and questions, so feel free to put your comments in the comment section, and I'll be happy to stand myself corrected or give my inputs as appropriate. Thank you so much for your patience.